Silver just crossed $60. Not in a quiet market, not on thin holiday volume. It broke through 60 while Asia was wide awake, pushing prices back and forth with violent speed. In the last 24 hours, spot silver traded around the low 60s, while intraday ranges stretched far wider than most investors expected. Volatility exploded during the Asian session, not New York, not London. At the same time, physical premiums in retail markets jumped again. Delivery times stretched, and dealers quietly raised spreads. This is not just a price move. It is a stress signal. Futures are moving fast, but physical silver is moving slower, and the gap between the two is growing. When silver rises this hard and this fast, the question is never how high today. The real question is where the pressure is building underneath the system. Because when volatility leads in Asia and premiums rise globally, the silver market is telling you something far bigger than $60. Most headlines stop at one number. Silver above 60, that is where the story usually ends. But that number hides the most important signal in the market right now. The real blind spot is not price. It is location. Almost all commentary still frames silver through New York charts and London fixes. Yet the most aggressive moves in this rally are happening while the West is asleep. During Asian trading hours, liquidity is thinner, but demand is more physical. Price moves faster and stress shows earlier. That is why volatility is clustering there first. Western markets see the close. Asia sees the strain. Another blind spot is the difference between financial silver and real silver. Futures contracts can be created instantly. Physical metal cannot. When spot prices surge, this fast dealers do not run out of metal immediately. They stretch lead times. They widen premiums. They quietly ration supply. Those are not price signals. They are pressure signals. A third blind spot sits inside exchange data. High reported inventories create a sense of comfort. But inventories are not availability. Metal sitting in a vault is not the same as metal willing to move at the posted price. When spreads widen between regions and delivery windows slip, the market is telling you that liquidity is conditional. Finally, there is the narrative blind spot. Many still treat silver as a smaller version of gold, a speculative cousin. But silver today is tied to industrial demand cycles and financial flows at the same time. That combination makes its moves sharper and more unstable. When media focuses only on the headline number, they miss the deeper message. The message is that stress is building unevenly across time zones and market layers. Asia volatility is not noise. Retail premiums are not anecdotes. They are early warnings. By the time the stress shows up cleanly in Western prices, the adjustment has usually already started elsewhere. In markets like silver, the most important signals rarely arrive where everyone is looking. To understand why silver is moving like this, you have to stop thinking in terms of price and start thinking in terms of flow. Silver does not rise in one market. It rises through a chain. Futures first, then spot, then physical, and finally retail. Right now, that chain is under strain at every link. It starts with futures. When momentum builds, large players do not buy bars. They buy contracts. Leverage allows price to move faster than metal ever could. Open interest expands. Short positions are forced to adjust. This creates speed, but speed is not supply. As futures lift, spot prices arbitrage pulls the paper move into the physical layer. That is where friction appears. Physical silver cannot respond instantly. Refiners need time. Mints need capacity. Logistics need weeks, not seconds. When futures lead too far too fast, spot prices rise, but availability does not. Dealers bridge the gap with premiums, not because metal is gone, but because metal is slower. This is the first mechanical tension in the system. The second tension is geographic. Asia plays a different role than the West. In New York and London, silver trades as a financial instrument. In Asia, it trades closer to a commodity. Industrial demand overlaps with investment demand. Liquidity is thinner and more sensitive to real orders. When price surges during Asian hours, volatility increases because fewer contracts are absorbing more intent. That is why price discovery feels unstable there. It is not manipulation. It is structure. A third layer is exchange optics. Large inventories on paper create comfort. But comfort is misleading. Metal registered in a vault is not the same as metal offered at current prices. When delivery requests rise and spreads widen, participants begin to test the system. Most do not want delivery, but the option matters. The moment delivery becomes interesting, leverage becomes dangerous. That is why markets watch delivery data quietly and react loudly later. The fourth mechanism is financialization. Silver today is not just a metal, it is a vehicle. ETFs pull in capital from investors who do not touch futures and never see physical bars. When ETF inflows rise, custodians source metal in bulk. That sourcing competes with industrial demand and retail demand at the same time. The market absorbs it until it cannot. At that point, premiums widen and availability becomes selective. Finally, there is the macro layer. Silver is priced in dollars. When the dollar weakens, silver does not just rise in price. It absorbs currency stress. It becomes a mirror for confidence. But unlike gold, silver carries industrial exposure. That makes its reactions sharper. When growth expectations and monetary expectations collide, silver amplifies both. This is why its moves feel violent. It is not one force. It is several forces pulling in the same direction through different channels at different speeds. Futures move fastest. Physical moves slowest. Asia reacts earlier. The West reacts later. Volatility appears first, where friction is highest. None of this is random. It is mechanical. When you see silver break levels with rising volatility and widening premiums, you are not watching a rally. You are watching a system adjusting to pressure that has already entered the pipeline. The impact of this silver move unfolds in layers, and each layer reacts on a different clock. The first layer is market structure. When silver pushes through a major level with rising volatility, the structure of trading changes. Liquidity providers pull back. Bid-ask spreads widen. Short-term participants trade faster and hold positions for less time. This makes price discovery more fragile. Moves extend further than expected, and reversals become sharper. Technical levels lose meaning because the flow overwhelms the chart. In this environment, silver stops behaving like a slow-moving commodity and starts behaving like a stress asset. The second layer is the physical market, and this is where the consequences feel more real. As futures-driven prices rise faster than supply can respond, dealers adjust quietly. Premiums increase not as a signal of panic, but as a rationing tool. Lead times extend because mints and refiners cannot scale instantly. Buyers who only look at spot prices think silver is available. Buyers who actually try to source metal discover friction. This gap between price and access is the hidden cost of volatility. It does not show up on a chart, but it shapes behavior. Some buyers delay purchases. Others rush orders. The physical market becomes uneven. This unevenness feeds back into pricing because it changes expectations. When access feels uncertain, confidence shifts. The third layer is macro signaling, and this is where silver moves beyond its own market. Silver, priced in dollars, reacts to currency expectations, but it also reflects confidence in the system that prices it. When silver rises sharply alongside volatility, it suggests that investors are not just chasing returns. They are hedging uncertainty. Unlike gold, silver carries industrial exposure. That means it sits at the intersection of growth expectations and monetary expectations. When both are in flux, silver amplifies the signal. A strong move in silver during Asian hours adds another dimension. It points to stress emerging in regions tied closely to manufacturing and trade. This matters because those regions consume silver not as a store of value, but as an input. When prices surge there, the cost pressure flows downstream. Over time, this feeds into broader economic narratives. Inflation sensitivity, supply chain stress, currency confidence. None of these appear immediately. They accumulate. Taken together, these three layers explain why a silver rally at this scale should not be read as a simple bullish story. It is a repricing event that ripples outward. Market structure becomes more fragile, physical access becomes more selective, macro interpretation becomes more complex. Each layer reinforces the others. That is why silver moves of this magnitude often mark transitions, not conclusions. They tell you that the system is adjusting, and adjustments rarely happen smoothly. From here, the silver market does not face one future but two distinct paths, and the difference between them is not opinion, it is activation. The first scenario is continuation. This path opens only if price holds above recent breakout zones while volatility remains elevated but orderly. In this case, silver closes consistently above the low 60s in front-month contracts and pullbacks fail to attract real selling. Open interest stabilizes instead of collapsing, which tells you leverage is being absorbed, not flushed. ETF holdings stop spiking and start grinding higher, which signals steady allocation rather than panic chasing. In the physical layer, premiums remain firm but do not explode, and lead times stretch without seizing up. This combination means the system is accepting higher prices without breaking. The activation trigger here is simple but strict. Sustained acceptance above prior resistance with no sharp contraction in volume. If that condition holds, silver does not need new headlines to move higher. Momentum becomes self-reinforcing because pressure stays distributed across layers. The second scenario is volatility unwind. This path activates not when price falls, but when structure fails. If silver drops back below recent support and does so with rising volume, the message changes. A fast decline, accompanied by collapsing open interest signals, leverage exiting rather than rotating. ETF flows stall or reverse, which removes a major marginal buyer. In the physical market, premiums may briefly spike, then soften as buyers step back and dealers protect inventory. This looks confusing to casual observers because price falls while access remains uneven. But it is a known pattern. Liquidity stress unwinds through speed, not balance. The activation trigger for this scenario is a failure to hold key levels, followed by a disorderly volatility spike that feeds on itself. In that environment, silver can move far and fast in both directions. Importantly, neither scenario is a prediction. They are conditional maps. The market will choose based on flow, not narrative. Watching price alone will not tell you which path is active. You have to watch behavior. Does leverage compress or persist? Does physical access tighten smoothly or fracture? Does volatility cluster or cascade? These signals arrive before conclusions. In silver, transitions happen quietly, and then suddenly. The purpose of these scenarios is not to call the top or the next breakout. It is to recognize which regime you are in while there is still time to adjust expectations. In markets under stress, clarity always arrives late. Structure always moves first. The last time silver felt this tense was not yesterday, and it was not last month. It was in 2011. Back then, silver exploded upward in a short, violent arc, and many still remember only the peak and the crash. But the structure beneath that move was very different from what we see today. In 2011, the rally was driven largely by speculative leverage and macro fear. The financial system was still digesting the global crisis, and silver became a proxy for distrust. Futures volume surged far ahead of physical demand. When leverage broke, the unwind was brutal and fast. What followed was not a shortage story, but a positioning story. Today, the setup looks calmer on the surface, but heavier underneath. Instead of one dominant force, there are several. Industrial demand is structurally higher due to energy transition and manufacturing intensity. Financial demand flows through ETFs rather than only futures, which spreads exposure across a broader base. Physical supply has less flexibility after years of underinvestment. These differences matter. In 2011, physical premiums spiked briefly, then collapsed as price fell. Access normalized quickly. In the current market, premiums are more persistent and regional. Asia plays a larger role than it did before, both as a consumer and as a price discovery zone. Another key difference is timing. In 2011, price ran far ahead of fundamentals, then snapped back. In this cycle, fundamentals and price are rising together, but at different speeds. That creates friction rather than pure excess. The similarity is psychological. In both periods, silver stopped being boring. Volatility became the signal. Media attention increased late. Retail interest followed price, not structure. But history suggests that the most important phase is not the peak. It is the transition when silver shifts from a quiet commodity to a contested asset. That transition is where mistakes compound and signals get misread. Looking back at 2011 teaches a simple lesson. When silver moves fast, the danger is not volatility itself. It is assuming the system will behave the same way it did last time. Markets rarely repeat. They rhyme. And this rhyme has a different rhythm, heavier, slower, and more global. That is why the current moment deserves comparison, not nostalgia. This is not a list of actions. It is a framework for reading the market while it is still forming. Start with the relationship between futures and spot. When futures lead and spot follows smoothly, the system is absorbing pressure. When futures surge and spot lags while premiums widen, friction is rising. That gap matters more than the headline price. Next, watch exchange behavior, not inventory headlines. Open interest tells you whether leverage is building or leaving. Stable or rising open interest during high volatility suggests participation. Sharp drops signal exits. Delivery data matters even if most contracts never deliver, because the option to deliver changes risk. If delivery interest rises quietly, leverage becomes unstable. Then follow ETF behavior. Sudden spikes in inflows often mark emotional phases. Slow, steady accumulation signals structural allocation. The difference determines whether demand persists or fades. Move outward to the physical layer. Retail premiums and lead times are not noise. They show how price interacts with reality. When premiums rise evenly across regions, the system is tight but functional. When they fragment, access becomes selective. That fragmentation feeds back into sentiment. Geography matters. Asian session volatility is an early warning because it reflects thinner liquidity mixed with real demand. If stress shows there first, it usually spreads later. Currency context sits underneath everything. Silver does not move in isolation. Watch the dollar not as a driver but as a filter. When silver rises faster than currency weakness, the move is internal. When both move together, confidence is shifting. Finally, observe volatility itself. Clustering volatility means the market is searching for balance. Cascading volatility means structure is failing. None of these signals alone give answers. Together, they give orientation. The purpose of this playbook is not prediction. It is awareness. In stressed markets, the biggest risk is reacting to price without understanding behavior. Silver does not warn loudly before it changes regime. It leaves clues. This framework is how you learn to see them before the narrative catches up. People ask the same questions whenever silver moves like this, and the answers matter because they reveal how the market actually works. First is whether silver at these levels means a bubble. High price alone does not define excess. Excess shows up when leverage expands faster than access, and when participation becomes emotional instead of structured. Right now, the signals are mixed, which means risk is present but not resolved. Another common question is whether physical shortages are real. The answer is conditional. Metal still exists, but not always at the posted price or within normal time frames. That distinction is critical. Availability is becoming selective, not absent. Next comes the question of Asia and why it matters so much. Asian sessions combine thinner liquidity with real demand from industry and investors. Stress appears there first because there is less buffer. It is an early signal, not a separate market. Then there is the question of whether silver is just following gold. The correlation exists, but it is incomplete. Gold reflects confidence in money. Silver reflects confidence in systems that use metal to produce real output. When those systems are under pressure, silver reacts differently. Finally, people ask how fast this can change. The honest answer is very fast. Silver transitions are rarely gradual. They compress time. Conditions can look stable until they are not. That is why watching behavior matters more than watching headlines. The purpose of these answers is not certainty. It is orientation. In markets under stress, the wrong question often causes more damage than the wrong answer. Everything discussed here is built from observable market data and openly reported disclosures, not private signals or hidden models. Price references come from spot and front-month futures feeds during Asian, European, and US sessions. Volatility is inferred from intraday ranges and session behavior rather than single prints. ETF behavior reflects publicly reported holdings and flow updates, with an understanding that reporting arrives with delay. Physical market conditions are read through dealer premiums, lead times, and regional spreads, which are directional indicators, not exact measures. Exchange statistics such as open interest and delivery notices describe participation and optionality, not guaranteed outcomes. None of these data points update at the same speed, and none tell the full story alone. There is always latency between what happens and what is published, and that gap widens during periods of stress. This analysis avoids forecasts and recommendations and focuses on structure and behavior. Where data is incomplete, uncertainty is acknowledged rather than filled with assumptions. Transparency here means knowing what the numbers can tell you and what they cannot. In volatile markets, confidence built on false precision is more dangerous than admitting limits. Silver above $60 is not an ending. It is a checkpoint. What matters next is not the next headline, but how the system behaves when pressure stays on. Watch where volatility lives. Watch how access changes. Watch whether structure adapts or fractures. These signals do not move on a schedule, and they rarely announce themselves clearly. They surface in fragments across sessions, regions, and layers. That is why this story continues, even when the price pauses. In the coming updates, the focus will stay on behavior, not prediction. On flow, not opinion? On what changes first when the system is stressed. Silver does not move quietly when it shifts regimes. It leaves traces. If you know where to look, you can see the transition forming before it becomes obvious to everyone else. This is not about calling tops or bottoms. It is about staying oriented while the ground moves. The market will tell its next chapter. Our job is to listen before it speaks loudly.